You're listening to the Pursuing Alpha podcast, hosted by Charles Brandon Snyder.
Hey, man, it's great to have you on.
Thanks.
I appreciate it. And it's the roles are a little reversed now,
I know.
right? So I was on your podcast a couple weeks ago, which I haven't heard. Has that come out really well?
Yeah, I've heard a lot of people say that they loved listening to you, even some people who've said, hey, I need to go talk to that guy. So I definitely think there was a lot on there that really kind of just helped people think about different things.
Yeah, I had so much fun on your
Good.
podcast. That's
I loved
awesome.
it.
So take 2 seconds and
Okay.
kind of give me an idea or give the listeners an idea of who you are, because there's so much I want to unpack with you
Okay.
today, especially in this weird time that we're kind of
Right.
in with the economy.
Yeah.
But I think in your space, it's going to add some clarity. So
Okay.
who you are and where you came from, what you do.
Okay, well, I'm Larissa Cable, and I'm a mortgage loan officer, and I work for Texas Tech Credit Union. And I went to Lubbock Christian, so I graduated from there.
Love Lubbock Christian.
Yes,
You know that.
Yes, I do know that. With the degree in psychology, I know, right? Never planned to be in the mortgage space. I don't even think I knew what a mortgage was or how to spell it correctly, that there's a T in there.
Yeah, right.
It's not silent. But yeah, so I ended up just kind of in this role because when I was in college, I worked at Wells Fargo Financial. And it was like a temp job that I ended up getting permanently. And I worked and just did like filing and things like that. And then I started helping them order appraisals and title work and all that. And so eventually that ended up me getting my first mortgage processing job.
Oh.
And so
what's that entail? What is a mortgage process?
So the mortgage processing piece is all the behind the scenes work on a mortgage. So like when the loan officer takes the application and they get the documents from the borrower, the mortgage processor, once they go under contract, they're doing all the reporting behind there. They're verifying income. They're ordering title appraisal. They're getting it through underwriting, getting conditions cleared. It's all the grunt work of the
Gotcha.
back end of the file.
It's all the detail stuff.
It is.
Cross every I.
Yeah. And
Dot every T?
Yes.
Is that how that works?
Yes. And most people I would say most loan officers that are really good loan officers, they started somewhere in the processing part or the closing part. They did something like that. Just
Isn't that
to
how
learn.
all business is? It's
It
like you
really
got to know
is.
from
You do.
start to finish how everything works.
Well, and I think that's what makes you good, because if you
Right.
understand the why of what you're doing, then it kind of all makes sense.
Sure.
So I started there, and I never thought that I would want to be a loan officer. I was very intimidated by that. It just seemed like it was a very stressful role, and it is. However, I mean, I didn't think that I would really be okay to do that. But I had a guy that I had gone through a divorce, and this guy who was a broker, he hired me to be a contract processor for him. So I worked like 2 days a week at his office, and he asked me one day, he's like, would you want to get your license? And at that time, like the place where I worked, you would have to be licensed.
So what is a license?
So you'd have to take a test.
Yeah. So what's a license called?
To be a loan officer.
So it is a loan officer license. Like we have Series 7, we have
Yes.
Series 6 and 63.
Yes.
We have all these different ones. So
Right.
it's just a loan officer's license is what y'all's formal license
Well,
is.
back then.
Back
so
then? Oh.
that was before 2008.
Okay.
So prior to 2008, before the crash, everything was different because you didn't have to be licensed at some point. But then, like me working at the credit union now, I'm licensed through the NMLS. But like if you go to work for like a Cardinal Financial or Benchmark or something like that, you have to take that test with them. I don't have to do that working at the credit union. So it's a little bit different. So like now I don't have to have that. But if I were to go somewhere else, I would have to go take that test again and do all that. So anyway, so I took that test.
Credit unions always get some advantages. I've
We
noticed.
do. And that is one of them because it's a hard test. I mean, it was extremely hard, and a lot of it's not.
But you've
like,
already passed it once, so
I could do it if I had to.
Yeah, right.
Yeah.
It's one of those things like it's kind of like going back and getting the Series 7
Yeah,
again.
yeah.
It's kind of like
You just don't want to
can
have to
if
do it.
right.
But yeah. So I took the test and I thought, he paid for it. He paid for me to go to Dallas. I had to go take classes and all that. And I thought, if you're willing to like do this for me, then why would I not do something
your
to better,
career. Yeah.
to better myself, whether I end up going that route or not.
Sure.
And so I did that, and he just kind of taught me the ropes of, since I already knew how to process, I mean, I understood the components of doing a loan. I just didn't really know like the sales part of it or just the relationship part. I knew I was really good at like just working with borrowers and helping them understand and just making them
The
feel at
education
ease.
piece.
Right. Yeah. And that's what I love. Still to this day is the education
That's
piece.
my favorite piece too.
Yeah.
I do it too much. That's my
Right.
problem.
Well, yeah. And so I got my license, started working a little bit there, and then just, more opportunities start showing up. That was in 2008. I mean, I was probably laid off from there to 2010. I mean, 3 or 4 times. It was a pretty wild
You're
ride.
talking about the great
Right.
recession of the
Yes.
COVID.
Yes.
Yeah, I mean that COVID housing crisis.
Yes. Yeah.
So it was a tough time for the housing market.
It was a tough time. And at that time, I was a single mom. So I was having to like take care of my kids. I didn't have any child support at that point and was just trying to figure out how to make everything work. But every single time, even though I was laid off, something better always opened up for me.
Isn't that how the Lord works?
I know. It really is. If you look back on it, I mean, I couldn't have written the story better. And so there's always, even in a disappointment, there was always something better that came along. And so I ended up getting a job at Lubbock National. So I was a processor there, and one of the loan officers there ended up leaving, and they asked me to take her spot. So I moved into a loan officer position full-time there, and then in 2000 and I think it was 2012 or actually I can't even remember.
Where'd you go to Alliance?
Well, hold on. I'll get there. Not then. No.
Okay, that's what I was thinking.
No, it wasn't then. No.
Okay.
So I left, because Lubbock National closed down their mortgage department.
Gotcha.
So I had a title company call me and want to hire me to be a closer. And I was like, well, I guess I'll go do that, right?
So what's a closer?
To like escrow officer.
Okay. Yeah. So you're at the very tail end, making sure everything's getting
Right.
signed,
They're
and you're
the-
making sure escrow money's going in, it's
Right.
transferring out.
Yeah.
So you got to kind of somebody that does all the pre-work, right? The relationship side to make sure everything's getting coordinated, double checking everything, and
Right.
now you have the closing side too.
Right.
Is that the main 3 sides?
Well, yeah, you've got the realtor, the lender, and then the title company. It's
Gotcha.
like, that's all the pieces. Yeah.
But inside the mortgage company, though,
Yeah.
there's usually 3 of y'all that's kind of working on those side, or 3
Yes,
different
because
departments.
because you've got, we're working closely with the title company to get them the documents, and then they work up all the numbers, and then we balance the closing disclosure, and then the title company, they're like that disinterested third party that's not representing the buyer or the seller. They're just there to do the transaction.
They get paid way too much, and there's too many developers that own all the title companies in Lubbock. But I digress.
You digress. Yes, I will too. But yeah, so I was actually offered a position to go do that. And I thought, well, I guess I'll go try that, right? And then Prime West called me and asked me, just come over here. And at that point, I was thinking, I am done. I am done with this business. I don't want to do it anymore. But Prime West at that time, they were just a powerhouse. And I thought, okay, if I can go over there and be successful, then I'm going to go try it. And so I did. I went over there and I loved it. It was great. I learned so much. But I was exhausted, and my kids, they were little, and I just thought, I want to spend more time with them. I want to be able to pick them up from school and all that. So I actually left there in 2014. And one day I just decided, I think I'm going to switch sides. I'm going to go to real estate. So I, within 30 days, got my real estate license and then switched into real estate.
That's a really good thing. So you've seen both sides of it.
Yes.
That's a huge advantage,
Yes, I agree.
both
Yeah.
for your clients and then also the way that you process things.
Yes. Yeah, I think so too. And I would say too, so when I left Prime West, I went to Keller Williams, and the training that I got there, I mean, just, it was next level as far as education, but also like goal setting and business development, personal development. They do it right. And so I learned so much that I feel like has even taken me further to just figure out what I want and what do you want, and then how do you get there, and just learning all those things. So I did that for 6 years, and I was doing that with my sister. That was kind of the whole idea, was that I was going to go over there and build a team with her. And we did that, and it was great. But then after the 6 years, I was kind of like, I don't know if this is going to last, with you and I.
Well, partners are always hard.
They are.
Then you're in variable. I mean, being a real estate agent, it's not consistent income. You
Right.
have good years, bad years. And I mean, you can make it even out. It's just like business is. But I've found that realtors usually really enjoy the boom, but they don't save enough for the bust.
Yeah.
And so it makes it really hard. But having partners is a whole nother complexity that goes into that. So it's hard to manage that.
And I think her and I were just kind of at different stages.
And being family on top of that.
Right, I know. Different stages of what we were wanting. I think our values were becoming a little bit out of line with each other. And so that was before 2020. So that was like the summer of 2019 that I told her, hey, I think I'm going to kind of do something different, do this on my own. And so I spent the next 6 months just working as a realtor by myself, and I liked it, but I really am very much of a team person. Like being around people. I thrive off relationships. And so after the first of the year in 2020, I kind of started thinking, what if I went back to mortgage? Like, is that crazy? I said I'd never go back. Just really kind of started getting the bug. And I thought, well, I don't know, it might actually be smart if I went back. Now that I have been a realtor, maybe I'd do even better. And so COVID hits, and about April, I start really thinking about, do I want to do this? And so I started talking to a few people and just getting their opinion. And they're like, I think it sounds like a fantastic idea. And so I ended up at that point, I ended up going to Alliance. And I started there. And so that was in June of 2020, and was there for a little over 2 years. And then I got recruited by Texas Tech Credit Union.
Yeah, we had a good friend together there.
Yeah.
Tom's been on the podcast.
Yes. And my husband works there too.
Oh, I didn't know that.
Yeah, he does. He actually started there before I did.
Really?
Mm-hmm. Which that made it harder. It was like, he worked there, he loved it, and he wasn't trying to get me to come over there, but at the same time, I
know Tom was.
He did want me to come over there. He did, but he wasn't like,
hey, if y'all haven't seen the
hardcore.
Tom podcast with us, y'all need to watch the Tom podcast. He's a great dude.
He is. He's awesome. And he is one of my very dear friends. And so, so I ended up moving over there. I wasn't really looking. It was just kind of one of those things. I was like, okay, I think this is what I'm going to do.
That door opened.
It opened. I saw an opportunity, and I thought, okay, I'm going to take it. I will regret this if I don't.
Sure.
And so I moved over. I've been there a little over almost 2.5 years. And I've loved it. It's been amazing. And so, so I've been officially back in the mortgage business for, going on almost, it'll be 5 years this summer. Yeah.
It's been that long already? Mm-hmm. Good grief. I just remember it being yesterday.
Well, that's what it in some ways it feels that way. In some ways it feels like 84 years, So, but
that means Ryan's getting old.
Still haven't gotten paid anything.
Yeah. That's great. That's amazing. It's a really good story, though. So do you really think that being a real estate agent and seeing their perspective of trying to get a deal done for both parties and working on that side and seeing the title side, seeing the mortgage side, then also seeing the real estate side, is that really helping you in that communication with the clients?
I do, because I learned so much about like sitting down and having a conversation with a buyer or a seller and just learning how to communicate. Real estate really did that for me. It upped my communication game on how to talk to people, how to read them, how to communicate, just all the different pieces of a transaction. And so, I felt like if I worked with a buyer, that's who I worked mostly with, because I also understood the mortgage piece. So I could kind of help there when I worked with buyers. So it's kind of now the opposite. When I've got a first-time home buyer who comes and sits with me, I can help understand, okay, what's going to happen now? What does this look like? And
you communicate the steps a lot easier.
Right. And so I just feel like that I understand those conversations that are happening with the realtor and with the buyer. And so I can help support that and help kind of explain some of that too, if they don't fully understand. Because it's a lot, especially when you're a first-time home buyer. You don't know what you don't know.
Sure.
And so if you can just kind of help ease some of that and make them feel comfortable and also be a resource for them, then I think it just makes people trust you more.
It does. And, and we've known each other for 10, 12 years now. And we've gone back and forth on deals and all kinds of stuff. And then, Jen's a realtor. I think she was at Keller Williams the same time you were there.
That's right. Because she was on Resides team.
She's actually turned into an incredible real estate agent just because she's gotten comfortable with it.
Right.
I think it takes,
and that's the key.
It is. Yeah. It takes 5 to 7 years of just being seasoned. Oh, I know what this is. I know what this is doing. And, and because early on she was just so green and she's such an introvert and such sweet and she doesn't want to do anything wrong. She's such a good person that it was hard for her. And I was like, just do our deals. Don't worry about it. You don't have to, go out there and sell. And so she still doesn't sell, but that's kind of how we kind of connected with Reside. I mean, I always say Reside, but it was Keller Williams at the time that the broker was. So, but it's neat to see your progression inside of where you're at, where you've gone. And now we got to get to the nitty gritty of it because there's so much stuff going on right now. Are you ready for all the 500 firing questions here?
Yeah, I think.
Are you ready?
Yeah.
All right. So I think, Ryan, can you shoot Jay? So having a financial analyst in house is a lot of fun because I get to walk in there and go, hey, tell me all the housing data.
Yeah.
Have you seen the housing data from October to November?
Like as far as the
new home sales, let's decrease by 17%, right? So in my mind, I look at it two different ways. One, and this is why I want your opinion on it, is I look like it's not a better time to buy a house than right now.
100%.
Right. And so it's whether it's December or January and rates are going to go down, everybody makes these stupid arguments and stuff like that. But I'm going, it is a buyer's market right now. And you have not seen in Texas for the last 4 or 5 years, a buyer's market because everybody's come into Texas since COVID.
Oh, longer than that.
Yeah, well, you're probably right on that, right? I know you're right. Like I don't keep up with it, but my perceptive was COVID hit, Texas became we didn't shut down as much.
Right.
Everybody from every crazy state out there that everybody came here, right? So it was really, really a tough time. But now we're kind of past that season and liquidity matters and people have to pay their bills and all these things happen. So I just see it as a good opportunity in real estate. Now you might have to hold that asset for a longer period of time.
Sure. Yeah.
So you need to know what you're getting into. But do you think it's a good opportunity in the market right now?
Absolutely. And here's the thing I think people really need to think about. Talk to the people who are in it the day in and day out, the ones that you trust. Because, I mean, number one, you're seeing deals right now where, say, you've got a seller who they're trying to sell their house and they're not able to sell it, but they've either got to move or they've got to do something, right? They're much more willing to give concessions to a buyer. And if a buyer can go in there and, strategize with the lender on how to make that deal work for them to get their payment where they want it to be, I mean, it's such a win-win because the seller ends up getting to move like they need to, and then the buyer ends up getting a payment they're more comfortable with.
So how would you help on the mortgage side to facilitate that? Like how give me some insight on that.
So there's so many things right now that I've done so many different type of options on strategy for financing. Like I had an appointment this morning with a buyer and we talked about number one, they didn't have a huge down payment. They're just going to have the minimum, right?
What is the minimum?
Well, so if you're a first-time home buyer on conventional, it's going to be 3%. If you haven't owned a home in 3 years, it's 3%, even if you have owned a home before. FHA, it's going to be 3.5%. And so we really look at both of those and see, okay, what's your credit score? What's your debt to income ratio? And out-of-pocket expense, what's a big deal to you? Because is 3%, 3.5%, is that going to be a huge difference? You're not going to see a massive difference in payment unless your credit score is just really pretty low. And so that's why we really kind of help them decide what is going to be the better option. Should we do FHA or conventional?
What's the difference between FHA?
So FHA and conventional. FHA, it is extremely, most first-time home buyers end up going that route just because you just have to have, we can go down below, we can go down to a 500 credit score on FHA. You got to put more down. But, as long as you're in that 620, 640 range, you're going to get a good rate, and it's a low down payment at 3.5%. You've got mortgage insurance on there for the life of the loan. So that's the big thing. For the life of the loan, or even if you exceed 20%? Even if you exceed 20%. But most people are going to refinance anyways. Exactly. And so that's what I tell people. It's like, you know what? Honestly, it doesn't matter how you get into the house. Let's get you into the house because we're going to refinance that note for you anyway. So if we get you into an FHA loan, let's figure out how to get your credit score up above a 740 if you're not, so that you can maximize and get a good rate when we refinance you. And at that point, then your mortgage insurance can come off after you've got that 22% equity.
Yeah.
Yeah.
So it's 22, or is it
Well,
really 20,
so-
but you need an
okay.
extra 2% for them to give that pad? for them to
Here's what
take it off?
happens is, like, say you get a conventional mortgage and you just put 5% down. That's going to fall off after you've hit 22% equity.
It automatically falls.
Yes, it automatically falls off. Now, if you say you did some remodeling to your house and you feel like your house is worth more now, you can actually ask the lender to get an
Reappraise.
appraisal and
Yeah.
see if it's come off. If it has, they'll pull it off. But that 22%, that's the mark where it's
That's the
automatically
threshold.
involved. Yeah.
That's neat. So we haven't bought a house in a long time that or been in, that doesn't have the 20% down,
Mm-hmm.
just because that, it's just, to me, it's wasted money. But as a lot of people need to go and pay for it, it's not that expensive.
No, it's really not.
It's not a big
No.
deal, but a lot of people make a big deal on it.
Right,
But
they do.
I forget the threshold. I always knew it was 20%, but
Yeah.
22 is more accurate, I guess.
It is when now, if you buy a house and you put 20% down, you don't have mortgage insurance. But the 22 is kind of the threshold, like you said, where it's going to actually fall off then. Yeah.
So what's jumbos now? 608 is what I heard. 608.
No, it's higher than that. So I can't remember off the top of my head what it is for 2025. They always change the limits for FHA loans, conventional loans at the end of the year. But it's like
Ryan, can you
it's
look that up
over.
for us?
It's like 800
Jumbo
maybe.
loans, what 2025 jumbo loans are?
Yeah.
Because that's where I get stuck in that world a lot,
Yeah.
and I'm like, I know it's, but
Up to, in 2025, it's going to be up to $806,000.
Yeah.
so I said 608 instead of 806.
That
but,
was like 5 years ago.
sorry,
It's okay.
806. Right. So $800,000 is a lot for a house, but I mean, with inflation,
Exactly.
you might get a
It's-
shoebox
right,
depending
exactly.
on where you live.
Right.
Right. So
Yeah.
800,000, but we bump up against that a lot with a lot of clients, and we're like, hey, I don't like, and this is, I got to be cautious here. I don't want to say it. I don't like. I say I always look at cash as king, and your assets can typically make more money than what a 3% home is historically going to appreciate at.
Right.
So if there's a $1 million house and you take a $500,000 loan and you put $500,000 into it, and then all you did is just gave yourself liquidity to be able to weather a downturn, and then also we can take that $500,000 and go put it to an asset that might make you more than what the loan is, and the arbitrage between a 3, 4, 5% loan that we used to do, and then what the a conservative asset class might make you an extra 1 or 2%. And when you start doing deductions on top of that, because you can deduct your mortgage, right? And up to, and if you're in a SALT state, it changes and all these other things that goes into it. But typically you can deduct that mortgage. So that, even at today's time at what is it? 6.6 or 6.8 or something like that is what the current rates are.
Yeah. 6.75 is what it earlier on a conventional. Yeah.
And we've had inflation over the last couple of days.
Yeah.
I think that's going to be short lived. So
Yeah.
everybody,
They'll bounce back.
It'll bounce back. The Fed next week's going to lower rates another 25 basis points. The CME data came out, or it's been out, and it says 97% probability they lowered another 0.25%. So I don't think we're going to have inflation over the next 6 to 12 months as what everybody's saying it's going to be. I think over the next 4 to 6 years, we might have massive inflation, but I think everybody needs to chill out, go buy assets when you can, refinance them as they get lower and go down the road. But hey, so how would you, unpack the mortgage process to me? Because even with my wife being in the real estate space, and then also just working with hundreds of clients and Tom and everybody else and you, unpack that process, like start to finish. Like, what do you do day one compared to, the timelines that gets into it? Because the title company gets confusing. Like, why do you have a title company? Why do you do all these other things? Can you go through that process for?
So I am probably I would say about 99% referral based as far as the realtor or, a past client refers someone to me. And so typically first thing is someone reaches out to me and just says, hey, so-and-so told me to call you. I'm interested in getting a mortgage. Can you help me with that? And so I'm like, yeah, I give
And
them.
it always make you feel good.
It
though.
does, yeah. And so I'm like,
It's my greatest thing.
do you want to meet in person? Do you want to apply online? Most people nowadays, they want to go ahead and do it online just because we're all busy, right?
Right.
So I send them my link and they fill out the application, and there's a portal, allows them to upload all the documents. I just set the expectation that once I've got this from you, I'm going to reach out to you and I'll send you something kind of showing you this is what I can approve you for. That's what it's going to look like in a payment. You're all in at closing. And I think that's the piece right there that is so important to help them understand, because a lot of people don't get it, that maybe you want a $250,000 house, but if you want your house payment to be $1,000 a month, that doesn't equal,
Unless
So-
you put more down.
Right. But if you're
It's
doing
all
it,
squeezing
it
a
is.
balloon.
So it's figuring out, okay, you've got to get to the bottom of what's most important to that person. Is it that monthly payment? Is it out of pocket expense? Where are they, and where's kind of their hot buttons? And so that's where strategy comes into play there. Like the people I met with this morning, they wanted their payment to be $1,300 a month, and they wanted a $200,000 house. Well, with taxes and insurance, and they're only putting the minimum down, that's not going to work.
Right.
So
Especially with taxes in
Right.
Texas.
So we either have to change our sales price, we've got to put more down, but how are we going to get there? With these people, I talked to them and we met in person and I went over everything with them. And that's where we talked about, okay, in this market, if you've got a seller who's willing to give you 6% concessions on FHA, how can we use that to help our strategy?
So explain that. What is a 6%?
Okay, so depending on the type of loan product you're doing, if you go FHA, the seller can contribute up to 6% of the sales price to the buyer's closing costs and prepaids.
Okay.
It can't go to their down payment. The buyer is always responsible for their down payment.
So what's a typical cost of closing costs?
So
I always understood it's 2%.
I guess that might. So a lot of it's going to depend on, like, you've got your closing costs and you've got your prepaids. Closing costs are going to be like your appraisal, your title work, which typically seller pays title work, your survey if the seller doesn't have one, the credit report, just all of those third-party fees that go into that. Then you've got your prepaids. Your prepaids are your taxes, insurance, and your days of interest from closing till the end of the month. And so those are actually you put those in there together, and that's all of everything. So I would say probably about, depending on the age of the home and everything, it's probably about, depending on sales price too, about maybe $8,000, $9,000 is that total right there. Closing costs themselves are probably going to be in the neighborhood of about, $4,000 to $5,000.
On what value of a house, though? 'Cause
I would, like the one I did today, I think the closing costs are right around, after the title policy's been paid and that comes out of there, you're probably looking at about $3,500, $4,000 for a $200,000 house. But then you've got, like I said, the prepaids, but that's all put in there together. But the seller can pay up to 6% of that on FHA, right?
6% of the home value.
Yes, of the sales price.
Okay.
So but what you have to be careful of, and this is where, like, working with the realtor, it's important to understand these things too. Let's say that you've got a $200,000 sales price and the 6% exceeds how much the closing costs are, which they're probably going to, because 6% is a lot. In this situation, let's say 8,000 is what I use to cover all the closing costs and prepaids. There's 4,000 left. Okay. I take that and I can then use it for a rate buy down. So I can do a permanent rate buy down to help get their payment lower.
That's interesting. I didn't know you could do that. Yeah, that's really
absolutely.
interesting. I knew you can do a buy down, but I didn't know you could use the FHA's sellers.
That's why sometimes, even if maybe their scenario looks great for conventional, maybe they're a 740 plus credit score, and maybe they could do 3% down. But we might look at FHA because then we've got more money to play with.
Sure.
So we can do a permanent buy down. There's also a thing you can do called like a 2-1 buy down or a 3-2-1 buy down. Do you know what that is?
No, you got to explain that one.
Okay. So like you can do a 2-1 buy down. That's probably the most common. And that's where the seller or builder pays for that. So if they're given that $12,000, they're already paying for it. And depending on sales price, loan amount, and all those things, it takes the difference between what the rate would be, or what the principal and interest payment would be, 2 points lower that first year over 12 months, and then 1 point lower.
It erodes over time.
Right. So
But does it go back to the original or what the current is at 2 years later?
So it's going to go back. So let's say I locked them in at 6% today,
Okay.
Right? So if you do a 2-1 buy down, that's going to buy it down to
4,
4%
then
year
5.
1, and then 5% after year, it goes to that one, and then it goes back to 6%.
Okay, so it goes back to what the original contract was, not what the current rate is in 2 years from now.
Correct. So the idea is you've got 2 years of a lower payment. By year 3, you want to refinance that. Refinance it or sell it. So even if I'm just going to be living in this house for another year or so, do a 2-1 buy down, because what happens so that money, it's essentially held in an escrow account, just like your taxes and insurance. And then the servicer takes the difference between those two payments and they're just applying it.
So you're actually at 6%. They're just arbitrarily actually using the extra funds to actually pay down what the principal payment would be.
And you can refinance it at any time before. There's no penalty to refinance. So you can do it before
what happens to that excess money?
It goes back to the buyer.
Does it really?
It does.
After a year later?
So even then, say you've got, say that buy down for that particular scenario costs, $4,000. Then say you just, after year 1, you still have maybe $2,000 left in there. You can take that. You could put it towards a permanent buy down if you wanted to. Because it will go toward, that's their money left over. Huh. It can go towards their principal, or they've got that money and we can use it and utilize it for
whatever it is in the future.
Yeah.
That's a really great strategy.
It is.
I haven't heard of that one.
Yeah. And I've done several of those. And here's the thing I have to think you have to remember is we don't know what rates are going to do. We have all this speculation. No one has a crystal ball. We think they're going to go down. I do think that they are going to go down. Advising your clients and telling them that too, because if you're going to be like, oh, we're going to be at 4% in 2 years, I don't know that. But at least.
Do y'all pull up the CME data and actually show it to your clients like we do?
That's probably a little bit more advanced for most people. I think what we really try to do is just help educate them on where we've been, where it looks like we think we're going. The disappointing thing to a lot of people right now is we thought we'd be further along at this point.
I did too.
Yeah, well, everybody did. Because that's what they told us. I mean, this time last year, they were saying, oh, we're going to do 6 cuts, by, summer, right? That didn't happen. And so it's hard to really know what's going to happen. But I think just if you can be that trusted person where you're at least giving them the data of this is what this looks like now. I can't guarantee what rates are going to look like, but this is going to put you in a better position at least for another year or two.
Sure.
That's a good option.
And that's why I like the CMA data, because it's all probability data and you're clear, but these are like actual data points that the CME puts together off of the 13 people that are actually in charge of the Fed fund rates that are all bankers, that are all corrupt. Don't get me started on that.
Yeah.
But this is actually their public remarks of them saying, hey, this is where I'm voting. And they have this little grid that you can follow, and then they just do the probability. So, our analysts look at this every single morning, and it went from like 98.4 yesterday to 97 today. So there's a 97% probability that next week, I think it's 17th or 18th, that the Fed's going to meet, that they're going to lower another 0.25%.
Yeah.
And I had a client today that just blew me up that says, what is going on? And I'm like, hey, because we're really conservative right now, probably too conservative over the year. But I'm looking at the economic data and I'm going like, this does not make sense.
Well, and that's the thing is it's so
we're
much.
We're in a recession and nobody's saying it.
Right.
We are in a recession. There's no question about it. And so that's the part where I'm like, y'all have a difficult situation because you have to bring buyers to the table and complete a process and complete the deal, right? And everything's out of your control. Ours is a little bit different because we have to do the hand-holding, relationship building and development, which is always my fun part, and I love doing it because I like the education. But then things don't go exactly the way you have planned. Like we planned back in July that'd be down 2% on the Fed's rate. And you're like, Brandon, why does this matter in wealth management? Well, it's directly correlated to bonds. So we did a huge study. We pulled up all these reports that if you looked at the 20-year treasury, for every 1%, this isn't linear, so it's not guaranteed. Don't take this as advice, right? But I'm just saying, on average, for every 1% the Fed lowers rates, long-term treasuries, 20 years, will go up 17%.
Wow.
Right? So if there's a 2% reduction in the Fed fund rate, that's a 34% return on top of the 3 or 4% that you're getting off the treasuries. It's usually around 3.5, right? So you could literally over get a 35-40% return. That's not guaranteed. I'm not giving financial advice here. I don't know your situation, but there's a high probability in that. And so that happens typically when they start lowering rates. And so here's 2 fun facts that get you into it. And we talked about this on your podcast. We're 779 days today or yesterday. I think it was yesterday or today. 779 days where the uninversion of the 3-year rate to the 1-year rate happened. And so we're considering now every time that's happened and all the longer duration bonds are now higher priced than the shorter duration bonds. When all those things uninvert like that, that is typically when the recession starts.
Right.
And so I think we're in that space where that's going to happen. Why this is good for mortgage buyers is guess what happens? Go buy a home now, and everybody's doing the stupidest thing I think that you can do. What do? They wait until rates come down,
Right.
and then they go buy the home, right? But the problem is so does everybody else do that,
Exactly.
right? So you're not in a buyer's position to actually go get the best house at the
Right.
best price.
Right.
And so you're competing now and it's back to a buyer's market. So this is why I talk to a lot of clients, like as long as you're doing a fiduciary, you're doing it in the right way to what your limits of spending are. Okay. So meaning I could probably afford a $300,000 home, but I'm going to go buy a $250,000 home or whatever the number is, right? I'm going to buy 10% less of a house just so I can get in that house at a higher interest rates. Refinancing it, I like your idea of like if you can do it that way and you can buy it back for 2 years, because there is good economic data that says that we're probably going to be lower sooner. I don't think it's going to be long lived. So my advice is buy the home now, pay the 1 year worth of higher interest rates. It's probably going to go down, which brings me to the question where I'm trying to get to in this deal is what's the most ideal minimum, maximum, or ideal, give me that range, low, medium, and high of when you need to finance. I always heard it's 1%, at least be over 1%
okay.
reduction. And then it makes sense to actually go refinance it because you got to pay closing costs and all the other fees that goes into it. But I want you to address that. And then I want you to address that if it's within 12 months, a lot of those fees are waived.
Well, okay, so the way that works is, number one, I would say a rule of thumb is going to be if you can get a 1% rate reduction.
Is that right, or is it more?
No, I would say it is 1%, but there's also other factors that go into that.
That's the rule of thumb, right?
Right, that's the rule of thumb. But everybody's scenario is going to be a little bit
Sure.
different. Number one, if you're planning on moving in a year, don't do it. You're gonna spend money on closing costs, and that you're not going to recoup that, right?
How long do you have to stay in the mortgage after you refinance? I think that's what you're alluding to. I always heard it as 3 to 5 years.
Well, that's exactly what I was going to say. I would say 3 to 5 years. But yeah, it's 1% is typically the rule of thumb. And so, because you can we can easily do calculations and show you if you stay in what you're in now, or if you refinance it, how much you're saving over the life of the loan. That's the big thing, because your monthly payment, even at 1%, that's not going to be a massive amount of change in principal and interest, but it's over the life of the loan. And so out-of-pocket expense over life alone, yes, you're saving a ton of money, right? But as far as closing costs, yeah. So, the way that kind of works is, if you don't do any improvements to your property, you can use your same survey. Title company will give you a credit for, and some of them it depends on, I've heard, it depends on the title company, that if you go back to the same place where you closed on the purchase, you will get that credit. Sometimes I've heard that if you go somewhere else, they may not give you credit, but that 50% credit, it just depends.
Okay.
Yeah. So
try to go back to the same
yeah,
one.
I would
You'll
say
probably have better luck.
that's really going to help you if you do go back to them. But yeah, you can use that same survey as a lender. Like if you did your purchase with me, I'm going to waive your processing and underwriting fees if you do a refinance with me. And that's just those hard costs to the lender. It's like, like ours is like $1,200 for those 2 fees. Every lender has different fees that they charge to do that, but everything else is third party. And so sometimes you don't have to have another appraisal. It just depends. When we run that whole scenario through underwriting, the automated underwriting, sometimes we can get an appraisal waiver that maybe that it kind of thinks that based on the area, it'll take the value that you put in there. So
that's good.
Yeah. So, I would say, again, depending on sales price, loan amount on a refi, you're probably looking at about $3,000, maybe more or less, for closing costs. that it's
Yeah, and if you have a $300,000 house and you cost you 1%,
Yeah.
you see what I'm saying?
Yeah.
And then you're saving 1% on the interest every single year for 30 years. The math's pretty easy at that point in
It
time.
is. And the thing too is you have to remember when you go refinance, if you want to buy down your rate, you can do that then too. Say you want to think about,
You got to address that.
okay,
Because I've never bought down a rate. I've never seen the advantages of buy down the rate. I've always seen it as like cash is king. I can invest it and make more money than what buy down the rate. So tell me what buy down the rate is, and then tell me how you would use it.
Okay, so buying down the rate means that when we go in there to price a loan, and back when I was in mortgage the first time, or even in 2020 when I came back, no one was buying down the rate. That's not
but that's back at when it was like
exactly.
2%, right?
Why would you? It
Correct.
made no sense to do that. But when you've got higher interest rates, when
8 or 9 that we've seen.
yeah, I mean I've seen some at 8. When you look at the interest rate, we go in there and we price it. You've got what is considered par, meaning there's no cost to get the rate. But then you can see, okay, if you want 5.875, this is how much it's going to cost. And what you've got to do is weigh how much is that costing me, and how long is it going to take me to recoup that cost? So again, how long are you going to be in that house?
So you really have to be forward thinking on what your expectations
100%.
are.
Yeah. Like for me, we built a house and we closed in August. Don't love the rate that I got, obviously, because
It's August was one of the highest times.
well, the really awesome thing that happened right before I was actually locked in at 7. And do you remember what happened in July? What was it that the market,
So September is when the reverse carry trade happened. I can't remember what July.
There was something
everything pulled back for a little bit on rates pulled back a little bit. I think it was one of the start of inflation was actually showing the ticking
right, that's
down.
what it is.
And then October was when the reverse carry trade happened.
Well, we closed in the middle of August, and there was one Thursday or Friday that something came out and rates dropped, and I got to float.
I think that was the inflation
Okay,
data.
I got to float mine down 0.5 point.
Oh, wow. So when you mean float it down, you mean that it automatically adjusted down?
No, here's what happens, and not every lender can do this either. So let's say you go under contract, and I've got you locked in. If rates drop 0.25 point or lower before closing, we can float it down. So it's
Got to exceed 0.25 point.
Well, the reason why we say 0.25 point is just because we are actually charged by the investor to do that. And so we've got to be able to recoup a little bit of that cost to be able to offer that. So that's why we say 0.25 point. But that's typically kind of the point in which we need to hit in order to be able to float it down. But it's awesome because I got to do it for myself. I've had several people that if the market times itself correctly and a report comes out, it can cause that, and you can then renegotiate that rate before closing.
That's really, really good.
Yeah.
Before you lock it in.
Yeah.
Are you seeing everybody do variable right now, or are you seeing everybody do 30-year fix?
Oh, definitely 30-year fixed. A lot of people, they talk about 15-year,
But the spread between the 15 and 30 is not justified.
It's not. And that's what I try to tell them is I'm like, let's do a 30. If you want to pay it like a 15, pay it like a 15.
So let's talk about that here in a minute.
Because
I know I can get you down to 15 by just actually paying more frequency.
So we just kind of show them those options. And I think that's the important thing is just helping people understand because they've been talking to Uncle Joe or Aunt Sally who's told them, don't pay mortgage insurance or you need to do this. And the reality is
they don't know this full situation.
They don't.
I live and die in that.
Yes,
that
you
space.
do. Yeah.
I'm like, Tom, my second cousin's
Yeah.
brother's kids told me that I shouldn't do this. And I'm like,
Just like
they have no idea what your situation is, and
they're
you're
the
taking
ones
it out of
that-
context.
Yeah, they go with them to the inspection on the house, and of course, they're all of a sudden a licensed plumber when you know what I mean. So it's that same thing. You got to be careful where you're getting your advice, and that's why it's important to talk to someone who
Doesn't
knows.
mean you don't listen.
No,
but
listen
you got to
to
be
them.
objective. The
You do.
problem is they listen and then they take it as it's the Bible and it's concrete, and they shut their mind off on being open minded of what the
Yeah.
conversation is, and that's when I
Yeah.
get like, all right, come on. Then you have to do the sell side of it. So our deals is the 3A's. So you got to acknowledge what their concern is. And then you got to ask a question, why is that important to you? And then you ask, how would you like to, what's the attractive thing for you to move forward with it? And so once you do the 3A's, then you're kind of like, Hermosi says it. What's Hermosi say? I think he says, be smoke, right? And so you can never actually grab it. And so we get all these things like, what's a good example just off the cuff? It's, hey, I'm not in the space of wealth management right now. And then you're like, that's interesting. Like, so why not?
Yeah.
Right. And then the more questions you can ask, the more you can get to the underlying problem. Sometimes it's like, I'm not in the timings wrong. My second brother's cousin's kids told me no, and here's the reasons why. But the problem is most people put this facade on, and that fake facade doesn't actually get to the underlying problem. But what the question is, and they just won't come out and say it. So the more questions you ask of saying, how would you handle this? And I tell my team all the time, I was like, if you're not asking 3 questions to their response, no matter what it is, then you're not actually understanding the client's story and what their concern is. And if you don't understand their concern, then you can never address it. You're trying to sell something instead of actually trying to help them. And so, and I tell this all the stinking time. It's like, you ask that question, then you ask it again, and then you go dig deeper and dig deeper and dig deeper until the point where everybody, I believe, tries to get to a yes. You're trying to get to a no.
Okay.
And so when you get to a no, then you actually know, like, no. I think this is a good. I just want this and this and this and this.
Yeah.
Well, they told you no.
Right.
Before they said, this is what I want off of that. Right. And so best book to read, I think anybody in sales, is read Chris Voss's Never Split the Difference. He was the head of the FBI. He wrote the FBI interrogation for negotiation for he's done hundreds of negotiations, of terrorist negotiations. He's like, and he really dives into, you got to get to the no.
Yeah.
And everybody is that. And I love Texas, and I hate Texas is everybody goes, oh, sweetheart, or, oh, yes, I'll do anything. They don't mean yes, they're going to do anything.
Bless your heart.
Bless your heart and all that other stuff, right? But it's all those little Texas-isms where nobody wants to offend. So they will tell you what you want to hear instead of actually what they mean. And it's really hard in our space to actually dive into that and go like, it's not what you mean. Tell me what you actually mean. So anyways, off on a tangent again, but my point going is you buy back the rate whenever it makes sense, and then you transition over to what's the next step, right? And then we didn't get back to how, I want you to answer, like, how can you make it where if somebody doesn't want to pay a 30-year mortgage, because I get this a lot, actually, how do I actually get it without having to buy? I think there's a disservice, unless there's a huge spread of owning a 15-year mortgage that I think is detrimental. Own a 30-year mortgage gives you flexibility and options. You're in the driver's seat of paying that down, right?
And you can pay as much as you want towards that principal.
But will they apply it? So here's
you have to make sure they do.
Yeah, see, that's the deal.
That's the difference.
Because we pay all of our mortgages because we have a lot of real estate properties, and so each one's set up different. I like to pay weekly. And make it applied weekly.
Do they do that?
Some do and some don't. So you have to call the actual, because and this is one I wish the Congress and everything would fix, is I wish they would fix the fact that you should be able to approve who sells you the loan, who the loan is sold to.
Do you know that would affect your interest rate though?
I'm sure it would.
Because when we go in there to like lock loans, we're choosing the cheapest investor. You're
choosing on the front end, right?
Yeah.
And then you come back and you're like, hey, this is cool. Here's the cheapest investor and here's what it is, right? And you agree to it, right? We sign documents, we go into it, and the loan's sold. My problem is it's 2 years later, they sell the loan again.
Oh, yeah.
And then they sell the loan again. You see what I'm saying? And then I end up with a carrier that has a poor website. They don't draft right. I mean, everything's against the debtor in this stance. And that's what aggravates me, is there's no consent by the the debtor on here. It's you're getting shuffled around inside of here. That's the part I don't like. I don't mind it on the upfront because you sign the disclosures and you agree to it and all that other stuff. It's when they sell it 2 or 3 times after the fact. That's when I get a little.
Yeah, and that's the hard thing. I mean, I
have one loan that's sold 4 times now.
That's so out of. I would assume that it's so out of our control. Number one, but even 100%, then, it's. I guess that's just kind of business, though, that someone purchases someone, and you know what I mean? I don't know.
Yeah, and but there should be consent there, because there's one carrier I've ran into in some of mine where I'm like, I don't want to be with you, and I don't have a choice.
Well, and I will say that there are some investors that we have just straight up, we won't allow them as an investor because of the bad reputation.
And when you say investor, you're talking about the actual holder of the debt.
Yeah, well, so that's 2 things. The holder of the debt is the investor.
Correct. But I just want you to clarify that to make sure that
so
y'all are not the actual debt holder. You're the Texas Tech Federal Credit Union might hold those on the books for a very short period of time.
Very short term.
Yeah, and then y'all tranche them together. I mean, somebody watched The Big Short, right? Mm-hmm. And y'all tranche them together and y'all sell them as a block, right? Yeah. And that's very, very common.
Yeah. Well, and that's, I mean, 95 to 97% of mortgage companies, that's what they do.
They have to.
They do. And you can get a portfolio loan at a much higher interest rate, and you can get, the term's not going to be great. We'll hold it on the books for you, but you're not going to like it. You're not going to like those terms. So it really is to your advantage to get a mortgage that we do sell.
Yep.
Because we're selling it to the secondary market.
Correct.
But so we talk about the investor, but then you also have the servicer. So that's different too. So the investor may be this person, but then I make my payment to this sub-servicer that
it's taking payment and is actually facilitating everything.
But all they do is take payments.
I still can't figure out how they make money. They have to be taken as spread off the top.
They do.
I just don't understand how that works. But that's a complex one that I'm sure I'd have to dig into the paperwork. But there's a lot of different components that go into that one.
Yeah. So it is very complex, and it's a space, man. I look back and I'm like, this is a lot to learn.
So who's packaging up y'all's mortgages and selling them?
What do you mean?
Y'all have somebody y'all have mortgages on the books through your 10, 15, 20, 30 days that y'all have to have a department then that packages all those up.
You have your closer who is actually working directly with the title company, right? That comes after underwriting, it goes to closing. So closing does that directly with the title company. Then you have your shipper. So your shipper is the one that does that. The shipper is the one who, this is where it's going, this is who it's getting sold to, but then we have to wait for them to purchase that. But there's times that, say the shipper sends it to the investor says, well, we're not purchasing this until you get us this. Say there's something missing, or they're not going to purchase this because of this reason. So that's also part of the challenge of our business is you can go to closing, but then it's on us to get that purchased to that investor. And they want it done in a timely manner. Then they start charging us as the lender. Hey, if you don't get us this document by this time, we're charging you this. So then the margins just start coming down that we're being paid on those. And so it's so much more complex than people realize from start to finish of all of the things that happen. And it's really not set up in I would say a positive way as far as, the lender is always the one carrying the liability from beginning to end to get it sold, to keep their margins where they need to be profitable. There's so many things that can come along that, let's say the appraisal comes in low, or, you've always got to do a profile change. Anytime anything changes in there, it can then change the margins. And so.
Are y'all selling these one-off, or y'all tranching them out and in groups?
That. Honestly, I don't know that enough about the secondary side to tell you. I mean, I know it's like what I do is when I go in there, I've got my 10 different investors I'm looking at, and I'm picking the one with the best
So
rate.
you're the one as the lending officer actually picking the
Yes.
ones and saying, I'm assigning it to this guy.
However, that doesn't mean
Is that when you lock it in?
yes. That
Oh,
doesn't
that's
mean
so
that's who it's
interesting.
that doesn't mean
Of
that's who it's
course.
getting sold to though.
Right. But that gives you the lock though, right? And you're
Yes.
saying, hey, I'm committing to this guy right here. Now it could go to somebody else, but at least
But this is what I'm locking in and at.
Okay.
And you got the difference between your best efforts locks and your mandatory locks. And again, that's a whole secondary piece that is like way over my head that I never did secondary. All I ever did, I did processing and then was a loan officer. But the secondary market, managing that, like that's a whole other ballgame that's like really over my head.
That's so interesting
Yeah.
to me though. I'm such a geek.
Well, and that's what I was going to say. I can think a lot of people that you could nerd out with on understanding all that and how they look at the market and the market's changing. So should we move this to a different investor and like all that kind of stuff?
Yeah, so y'all can actually change that after the fact of moving it to whatever investor. That's very, very neat.
Yeah.
And so it's fun because the consumer doesn't get to see all those.
No, they
angles.
don't. And that's what I think is so interesting too, that I wish people really understood. I mean, I feel like we work so hard to help them and try to help them strategize, get them approved. I mean, like I'm not going to give an approval letter unless I have your documents in hand.
Sure.
And there's a lot of lenders out there that they'll just pull credit and they won't get pay stubs, they won't get W-2s, and they'll give an approval letter. That doesn't mean you're going to closing.
No, we had, when I was 19 years old, we had a huge experience with the national, one of the big 4 or 5, and they gave us an approval letter, but they didn't pull everything, and then we ran into problems, and it ended up costing us. I was 19 years old, and I just and everybody was like, you should go see an attorney because you have their approval letter.
Yeah.
And I was like, this is a horrible experience ever. And it was like being 19, and we were fortunate at 19 to be able to go, try to buy our first house.
Right.
Well, I was 19. I was 20. And so me and Jen, and I was like, this is crazy. And we ended up losing, when you're 20 years old and you lose a couple $1,000s off
That's
that.
a lot of money.
It's a lot of money. And it just destroyed me forever on that. So making sure you have a very, very good credit, a very good mortgage officer, but also a very good understanding of the process and when you're committed.
Well, and that's where I think that not every lender is the same. Like I said, I mean, I prefer sleep at night. And so I want your pay stubs. I want your W-2s. I want to know where your money's coming from. I want to see those bank statements. I want to see that you've got that money in there. And if you don't have it in there, where's it coming from? Is it being gifted to you from your mom?
Right.
What is our plan? And I think what a lot of people right now, whether it's the realtor or whether it's the buyer, is they don't understand it's such a complex process of making sure all that's done that they get the cart before the horse. And so they go find the house they want and they're like, oh, I got to hurry up and get my approval. Well, I want to get it for you as fast as I can, but I also want this to be a good experience for you. And I want you to be able to trust that if I'm giving you an approval letter, you're going to closing. And so I think that's what I love about the realtors I do work with is they know when I'm giving an approval letter that
There's no questions.
There's no questions. And you know what? Maybe
because their livelihood relies on that too.
And it's not fair for me to give an approval letter to a buyer and they go put in an offer. It's not fair to that seller.
Yeah, it screws up everybody.
It screws up everybody. And so you've got to make it a win-win for everyone. And so that's where I feel like it's just so important to help people understand. And that starts with the realtor too, is that if I've got a buyer that, comes to me, they're self-employed and they own 5 different businesses and they want an approval letter within an hour and you haven't even gotten me your tax returns, I'm not giving you that approval letter.
Yeah, no. And so we got to talk through that because that's probably the hardest thing that I fight is. And it's such a great point. I mean, really good point because a lot of the clients that come in here are business owners. And that big stigma is like, hey, they've been working in the business for 18 months. They've made $1 million and they're doing well.
Yeah.
But they hadn't hit the 2-year mark.
Yeah.
And so it's like, oh no, you know what I'm saying?
Yeah.
And so we get creative. And what's weird is, this is the weirdest thing, I am now work with almost 47 banks, and we became one of the largest institutions using a certain product of wealth management for bridge financing. So now a lot of our clients are coming to us, all business owners, that says, I have surplus capital sitting on my books at my company and I don't know what to do with it. I can't spend it because I need it in my business.
Right.
But I want to be able to I want to go buy a boat. I want to be able to go buy a lake house. I want to be able to go do these things, right? But I can't figure out how to do these things right and make sure I'm a steward of the capital, that it stays on the books of the company and I can invest it, right? So we actually go help them go through that. And half the time, and I've worked with Tom, I've worked with you, and a lot of times that y'all don't even know this. It's like I'm working with bridge financing on the back end. So we'll go out there and say, all right, go execute this, go buy this rent property, go buy this house, whatever it is, right? We'll use their investments, but I don't want to sell the investments because it costs the client 23.8% in capital gains tax, right? So I'll go and secure financing for them to be able to go buy that asset, and then we'll repaper that asset back up into a 30-year fixed after the fact.
Yeah.
I'm doing that with I think 9 clients right now. I mean, Tom's had that conversation a couple times. I've reached back out on a few that we've had together. I don't even think you've known about them, a few.
Probably not. No.
Yeah.
The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.
The last thing here is we've gone over so many things of how it works, the process it is, and all the complexity that goes into it. But the biggest thing is I want to ask 2 things. One is, what's the easiest way to get a mortgage today? And I know just getting online, connecting you, but when's the right time to do it, right? And so I'm always if you can have at least 5 or 10% of savings, right? And you feel like, you know, it's in your best interest to actually stay in the location you're at, and you like the home where you're going to stay there for 5 years, and you're not exceeding 30% of your income limits. We call it debt to service coverage ratio, but y'all call it debt to income ratio, right?
Yeah.
And so is 30% the right number, or is it higher?
Oh, it's way higher.
I
mean,
know,
on
but-
FHA, you can go up to 57%.
I know, but can we be reasonable and say 30 to 40%?
Yeah. Oh, we could say whatever you want to say.
Yeah.
I mean, but yeah.
But the limits are way higher.
They're way
right?
higher.
But if you're paying more than 40% at the high side,
Yeah.
then you don't have, life no longer becomes fun
Right.
because you're just paying to live in a house.
Yeah. And that's one thing that I feel like I try to show them, okay, this is what your payment looks like. This is what you're going to be paying monthly. And it's important to get them to understand it. This is what you're paying right now. Your taxes and your insurance, they're going to go up.
Yeah.
And so
Tell me about it right now.
Right.
It's crazy
and so
in Texas.
it's trying to help them understand that, yes, you can refinance, but being prudent and being a homeowner, that you don't want to completely strap yourself that you can't sleep at night because you're worried about your payment because you can't do other things too.
Right.
And so and that's what I feel like is important as a lender is I want to create that trusted relationship that they're going to come back to me. So I'm not going to tell someone, oh, I'm not going to let you go up to 57%. I'm just trying to get them to understand what that looks like. So what does that look like in real time for them in their life?
Yes. Painting the story or telling the story and just showing them how this might not be in your best interest to do this, or you're going to have to suffer through it. Because I have to do the same thing. I've got clients where I'm like, hey, I wouldn't do this. Here's the reasons why. And we're going to both agree that I told you this, in 6 months or a year later when things don't work out the way you want to, right? You're
and at the end of the day, it's their decision.
Right.
And people are going to do what they want to do. And I think a lot of times they do get really excited about the house and the process and all that. But that number on paper doesn't compute to what that looks like in real time.
Yeah, 2 or 3 years from now. Yeah. I got a great story around that. And so just a quick one is I was working with a client, and he had one of the largest houses from Vegas to Atlanta in West Texas, or in Texas, I guess. It's not West Texas where he was at. Largest houses. I mean, it was like 40,000 square feet. And I asked him, I was like, hey, so, you're 3 years in on building this house. I mean, it's an immaculate house. It's just gorgeous. Guy makes an incredible amount of money. Just really good businessman. And I was like, hey, is it worth it? Was it worth it? And he goes, Brendan, after 6 months or a year, he goes, all the $1 million fireplace and this and all of that stuff, it just kind of becomes a house.
Yeah, it does.
Right. And so I always tell clients, like, don't get stuck in
Right.
I'm buying a new car, I'm buying a new house, and that euphoria that you get of the purchase.
Right.
Think through what it's going to look like 5
Right.
years from
Yes.
now, because that is so important.
It is. And it's at the end of the day, it's just a car. It's going to depreciate. And the same with the house. You want to create a good experience for them because you want them to come back to you. You want them to refer their friends and family and all those.
Yeah, you got to run a
things.
business.
Right. And so that's what I really try to do is just help create that.
But be honest with them.
Being honest with them
Yeah.
and teaching them the process, which that's one of the things I'm most passionate about is just the education piece. And so that's
It's
what
fun,
I've
isn't
tried
it?
to do. Yeah. For realtors and buyers,
Yeah,
both.
that's fun.
Yeah.
All right. So one, I want to point out that I've done a lot of stuff with Texas Tech Credit Union, but y'all aren't Texas. Y'all can go anywhere.
Oh yeah. We can go any state. We can lend in any state.
Yeah.
Yeah.
That's awesome.
is.
I've used that quite
Yes.
a bit.
You can
right?
buy a second home in Florida or Ruidosa, like wherever you want to go. I've done lots of loans in different places.
I've done 4 or 5 in Florida just
Yeah.
last couple of years. I wish I would have told them to wait another year because
Yeah.
Florida's really tough right now.
Yeah,
but
it is.
it's good. So how do people get a hold of you?
So they can reach out to me online. If you Google my name, Larissa Cable, you can find me pretty much anywhere. But on Instagram, I am larissacable.mortgage. And then on Facebook, I am Larissa Cable, Mortgage Loan Officer.
And you're at
Texas Tech Credit Union. I'm at the location at 6319 79th Street. So that's our operations campus.
I like the credit union side of it.
Yeah.
I like it because it's like you become, in my world, you become a shareholder of the actual credit union because that's kind of what credit unions
Right.
are.
We're member based.
You're
Yeah.
member based, right?
Yeah.
And so that when you do stuff on that side of it, I always feel like I'm a shareholder now, so you have to represent me in the most ethical
Right.
manner, right? There's
Yeah.
it's not a for profit and then this,
Exactly.
right? And so that's what I like about it. So
Well, and I think too, we are very relationship based. So even if you don't fit that mold of that loan, we can also look at other options to keep in house for you until we can get you into a better product. And so that's one of the valuable things we have too.
awesome. You got any good takeaways?
I don't know. I'm excited about 2025. And just, I saw something the other day of instead of asking someone what their goals are, like asking them, what are you excited about? And to me, that is such a better question to ask someone because I think 2025, the last 2 years have been really hard. And so just really leaning into the newness of the year and the possibility, because there's always something excited about possibility, you know?
Yeah.
So yeah.
There is a lot of possibilities out there and fun new adventures, right?
Yeah.
So I appreciate you having
Yeah, thank
being
you. I
on,
appreciate
and
it. It was
I had
fun.
a lot of fun.
Yeah, I did too.
See you next time.
Yeah.